What actually moves tech stocks long-term? Technology stocks often feel like the most unpredictable part of the market. They surge on innovation headlines, collapse on rate fears, and swing wildly around earnings. To many investors, tech prices seem driven by hype, speculation, or short-term trends. But over long periods of time, tech stocks are not moved by noise. They are moved by a small number of powerful forces that consistently shape long-term returns. To understand what actually moves tech stocks in the long run, we need to look beyond day-to-day price action and focus on fundamentals, capital conditions, and expectations. The most important long-term driver of tech stocks is earnings growth, but not in the way many people assume. Tech companies are valued primarily on future earnings, not current profits. Investors buy tech stocks because they believe these companies can scale, expand margins, and generate large cash flows years into the future. Over time, the companies that actually deliver on these expectations are the ones whose stock prices compound. Hype may drive short-term moves, but sustained earnings growth determines long-term success. Closely tied to earnings growth is business scalability. Tech companies that build platforms, software, or networks can grow revenue without increasing costs at the same rate. This operating leverage allows margins to expand as the business grows. Markets reward this structure because it creates durable profitability. Tech companies that fail to scale efficiently eventually disappoint, no matter how exciting the story sounds. Another major long-term driver is competitive advantage. Technology moves fast, but lasting winners are not defined by innovation alone. They are defined by moats, ecosystems, switching costs, data advantages, network effects, and brand trust. These factors protect earnings over time. Tech stocks that dominate their niches and defend their position tend to outperform across cycles. Capital conditions also play a crucial role. Because tech stocks depend heavily on future cash flows, they are highly sensitive to interest rates and liquidity. When capital is cheap and abundant, investors are willing to pay more for future growth. Valuations expand, and tech stocks outperform. When interest rates rise or liquidity tightens, future earnings are discounted more heavily. Even strong companies can see their stock prices fall, despite solid fundamentals. This is why tech stocks are often volatile, but volatility does not define long-term direction. Another long-term driver is expectation management. Markets do not reward companies simply for growing. They reward companies for growing better than expected. Tech stocks that consistently exceed expectations see valuation support. Those that miss, even slightly, can experience sharp repricing. Over time, the best-performing tech stocks are often those that underpromise and overdeliver. Narrative matters, but only temporarily. Stories about disruption, artificial intelligence, cloud computing, or platform dominance can push tech stocks higher in the short term. But narratives only last if results validate them. When reality diverges from the story, valuations compress quickly. Long-term tech winners are those where the narrative eventually becomes fact. Another overlooked factor is capital discipline. In earlier growth phases, tech companies often prioritize expansion over profitability. Over the long run, markets reward those that transition successfully into sustainable cash generation. Companies that burn capital without a path to profitability eventually lose investor confidence. Cash flow matters more than vision over time. Tech stocks are also shaped by regulation and maturity. As companies grow, they face regulatory scrutiny, slowing growth, and market saturation. Long-term performance depends on how well management navigates this transition. Mature tech companies that adapt continue to generate returns. Those that fail stagnate. This is why not all tech stocks remain growth stocks forever. Importantly, long-term tech performance is not linear. There are long periods where tech stocks underperform due to valuation compression, macro headwinds, or sentiment shifts. These phases often feel like the end of the story, but they are part of the cycle. What matters is whether the underlying business continues to strengthen. In summary, what actually moves tech stocks long-term is not headlines, hype, or short-term volatility. It is sustained earnings growth, scalable business models, durable competitive advantages, capital conditions, and execution over time. Markets eventually separate strong tech companies from weak ones. Once you understand this, tech stocks become less intimidating and more understandable. They are not lottery tickets. They are long-duration businesses whose prices reflect beliefs about the future, beliefs that must eventually be earned.